This is Peter Hughes of Financial Intergroup, and welcome to this BCBS 239 tutorial. Today I'm going to demonstrate how risk accounting can solve some of the issues relating to the implementation of the Basel Committee's effective principles for risk data aggregation and risk reporting, otherwise known as BCBS 239. The solution I'm about to describe to you is available in software called Advico RAS, the RAS standing for Risk Accounting Solution. I'll provide you with more details on this at the end of the tutorial. We're specifically going to focus on these elements of BCBS 239. Principle 3, Accuracy and Integrity, Principle 5, Timeliness, and Principle 7, Accuracy. We could collectively refer to them as risk data controls. They address aspects such as the reconciliation and validation of risk data, the introduction of accounting-like control over risk data, and the need for timeliness in risk reporting. At the risk of stating the blindingly obvious, we need two things if we are going to aggregate risk data effectively. The first is standardized identification systems, that is, the systems of coding we use to identify data. If we want to aggregate data that's spread across multiple systems in multiple locations by, for example, legal entity, we need to tag standardized legal entity identifiers, or LEIs, onto each item of data so computers know which hierarchical aggregation paths the data should follow. The second is a standardized risk exposure quantification method. We can't validly consolidate and aggregate data if the quantitative values assigned to them are produced by different measurement methods. For example, miles and kilometers measure the same thing, distance, but we can't aggregate miles and kilometers and expect to get a meaningful result. So my key question for this session is, in the absence of a standardized and universally accepted method of calculating exposure to risk, are BCBS 239's accuracy, integrity, and timeliness requirements achievable? And here we have the problem. On this slide we've listed the principal methods used by regulators and risk managers to identify, quantify, and report exposure to risk. Each one of these methods produces outputs that could loosely be termed risk data. The Basel Advanced and Standardized approaches shown at the top of the slide are used to determine a bank's capital requirement, and the bank internal methods at the bottom of the slide are vital for ensuring that banks properly manage their risks at the granular level. But again, at the risk of stating the blindingly obvious, we can't aggregate the outputs from all these different risk identification and quantification methods. The result would be meaningless. We have a particular issue with the bank internal methods at the bottom of the slide because they are assessment and not measurement based. For example, in the case of operational risk, banks typically use RAG assessments, where we identify possible exposures to risk and assess the likely impact of operational failure by using a system of three colors: red, amber, green. Again, invoking the blindingly obvious, we can't consolidate and aggregate colors, and yet this is the technique that is universally used by financial firms to manage their operational risks through tools such as risk and control self-assessments, RCSAs, and key risk indicators, KRIs. So is BCBS 239 dead in the water? It possibly is, unless we can think of something new. Let's start by looking at the problem from an accounting perspective. Accounting involves the registration of all transactions upon their approval in accounting systems. Upon registration, each transaction is tagged with codes that are used by computers to ensure it follows predefined aggregation paths. From the codes tagged onto transactions, they can be aggregated to give us, for example, business line profitability, customer profitability, product profitability, legal entity profitability, geographic profitability, and so on. We also capture transaction values on registration, which can be, for example, historic cost, notional value, or fair or mark-to-market values, and there may be other values. That means that every time we take a different cut of accounting data, for example to construct product profitability, we can use aggregated transaction values as population controls to tell us whether the data we have used is complete and accurate. Almost by instinct, accountants embed control totals based on transaction values throughout their financial reporting processes to ensure they are complete and accurate. And all accounting data is generally tied back to its single authoritative source, which is the general ledger. When thinking about risk data aggregation in the accounting context, we started to think whether we could tag a new transaction value onto each transaction, its exposure to risk. In conclusion, if we tag transactions with risk codes that can be used in a standardized calculation of each transaction's exposure to risk, we can use the same controls, trusted data sources, and aggregation paths for risk data that already exist for accounting data. Accounting standards have evolved over more than a century and are now framed in what we call International Financial Reporting Standards, or IFRS, or Generally Accepted Accounting Principles, or GAAP. They are highly prescriptive and ensure that there is only one acceptable transaction value that can be used for accounting purposes. In other words, accounting systems are monovalent. This entry in Wikipedia summarizes the concept quite nicely. Existing accounting systems are primarily monovalent, that is, a single accounting value is attributed to a specific object or purpose. In contrast, risk and uncertainty are formally characterized by a whole range of possible values connected to an object. Accountants learned a long time ago that only through a monovalent system is it possible to achieve the kind of control framework that is now being demanded by BCBS 239. We need a monovalent system if we want to embed controls in operating infrastructures through techniques such as reconciliations and substantiations, effectively aggregate data, achieve direct comparability of outputs, create single authoritative sources of controlled data, and create firm-wide operating limits that can be effectively monitored. In finance, we refer to budgets. In risk, we refer to risk appetite. In principle, they have the same purpose, that is, tracking actual usage against a predetermined limit. It's now that we need to engage in some revolutionary out-of-the-box thinking. The first point is that any universal measurement system needs a common standardized unit of measurement. A natural currency used for accounting is not a good standardized unit of measurement for exposure to risk for the reasons shown on this slide. There are many currencies, and their values relative to each other are constantly changing. The quantification of exposures to financial risks in monetary terms typically involves the application of financial models that we refer to as stochastic techniques, which are difficult to standardize, are invariably complex, and inherently lagging. And perhaps most significantly, exposures to non-financial risks, for example operational risk, cannot be validly expressed in monetary terms. We concluded that the solution was to create a new additive risk metric, a common standardized unit of risk measurement. The new risk metric we've created for risk accounting is the risk unit, or RU. So when we calculate each transaction's exposure to risk, the result is an amount of risk units, or RUs. If we can accept that groundbreaking principle, a standardized method of calculating each transaction's exposure to risk using a common standardized risk metric, life in the world of risk data control, aggregation, and reporting starts to become a lot easier. Now we can calculate and validly aggregate exposures to risk across the enterprise. Here is an interpretation of risk accounting's three core metrics. Inherent risk in RUs is representative of a transaction's maximum potential for loss. The risk mitigation index is a measure of the effectiveness of the enterprise in mitigating inherent risk through the effective management and control of the firm's operating environment. And residual risk in RUs is the portion of a transaction's inherent risk not covered by effective risk mitigation that represents its probability of loss. So, how do we calculate the RUs transaction by transaction? In the short time available, we hope to at least give you a sense of how the risk accounting method works, but we have other more detailed resources, worked examples, and training courses available. I'll provide details of where you can find these at the end of the session. There are two components that we use in the calculation of inherent risk. The first is the value band weighting, or VBW. We aggregate transaction values by product using the accounting values as determined by accounting standards and the Bank Standard Charts of Accounts, or SCA. The result is general ledger account balances and account movements aligned to products. We map the product totals to Risk Accounting's value table and extract the applicable value band weighting. We'll take a more detailed look at the value table in a few minutes. So the first component that we use in our calculation of inherent risk is the account balances and account movements by product per accounting records. That means we have satisfied one important BCBS 239 requirement because our risk quantification system is tied to official accounting records. The second component is the exposure uncertainty factor, or EUF, which is the relative degree of precision that can be achieved in determining a product's potential to cause unexpected losses. Uncertainty is synonymous with risk. Where there is high exposure uncertainty, there is a high probability of unexpected loss. We'll take a more detailed look at Risk Accounting's EUF tables in a few minutes. When a bank approves a transaction, it triggers processing risk and a combination of credit, market, liquidity, interest rate, and conduct risk. Processing risk has three subcomponents: operations, data, and core applications. In other words, people, data, and IT. For example, in the case of processing risk, if we accept a transaction for processing and our operating controls and security are poor, we could potentially lose control over our accounting records. The result is we will not know with certainty what is owed to us and what we owe to others. In other words, in these circumstances, we will have a high processing EUF because there is a high probability of unexpected loss. Here are the other risk types with examples of EUFs. Credit risk. In the event of a credit default, a mortgage loan has a high credit EUF because of the uncertainties associated with liquidating a mortgage asset and realizing its book value. Market risk. If we unwind a trading position on a given day, a complex OTC derivative will have a high market EUF because it could take months or even years to liquidate the portfolio. Liquidity risk. If we do not have access to stable sources of funding, we will have a high liquidity EUF dependent on the risk characteristics of the product we are required to fund. Interest rate risk. Products that have a high sensitivity to unusual movements in interest rates will have a high interest rate EUF because they typically have longer maturities and fixed rather than floating rates of interest. Conduct risk. Investment products, or products that are the result of bundling multiple products such as insurance linked to a loan or an interest rate swap linked to a loan, or products that have designated sales incentive schemes, will have a high conduct EUF due to the elevated possibility of mis-selling and the occurrence of unexpected loss due to litigation or governmental or regulatory penalties. This is the value table. As you can see, the progressive increase in the size of the value bands accelerates at a faster pace than the associated value band weightings. What this is designed to depict is the relationship between cumulative transaction values and risk, i.e. the marginal increase in risk reduces as cumulative transaction processing values increase. This effect is the consequence of the natural enhancement that occurs in processing sophistication, primarily through increased automation, when transaction volumes rise. For example, if an operating unit was handling transactions in Band 1, that is less than $62,500 worth of transactions, and they were required to increase it by $1 million on a particular day, there will be a high probability of operational failure, as a unit operating in Band 1 will depend predominantly on manual processes. But if a unit is operating in Band 12, that is transactions up to a value of $128 million, and they were asked to increase their processing volume by the same $1 million, they wouldn't even notice the difference, as they will already be highly automated. This is better illustrated in the column on the right of the chart that plots the effective change in risk in each band. The change starts steeply at 11.20 in bands 1 to 2 and becomes negligible by band 12, that is 0.13. The interpretation we place on this is that banks generally achieve full automation of a product's processing when daily values reach between $64 and $128 million. This is the credit EUF table. Credit workout and loan recovery experts have assigned an exposure uncertainty factor, or EUF, on a scale of 0 to 20 to credit products based on their assessment of the relative difficulty they anticipate in liquidating collateral and the collateral's value retention properties. For example, an unsecured commercial loan at the top of the table has an EUF of 2 because, on an assumed default, the exposure and loss potential of an unsecured loan is immediately known. But a loan secured on residential property at the bottom of the table has an EUF of 16 because the process of foreclosing on a defaulted residential property loan and disposing of the property within a reasonable time frame and an acceptable liquidation price is complex, with a relatively high degree of uncertainty as to the amount of loss that might ultimately be written off. There are EUF tables for each risk type: processing, credit, market, liquidity, interest rate, and conduct. This is the calculation of inherent risk. We start by aggregating transaction values by product, which is a natural output of accounting systems, and mapping the total to the value table and extracting the applicable value band weighting. The amount of inherent risk in RUs is the result of multiplying each product's value band weighting by the EUF of each risk type triggered by the product and summing the result for all applicable risk types. Now let's look at how we calculate the Risk Mitigation Index, or RMI. Risk accounting is fully aligned to enterprise architectures. We identify the business components that comprise the bank's organization and assign the components that are involved in the approval, processing, accounting, and reporting of transactions to one of 4 categories shown on this slide: transaction processing, risk management, core applications management, and data management. Transaction processing can be characterized as a journey through a bank's operating environment and is sometimes referred to as the end-to-end processing cycle, which starts with the transaction's origination and ends at its registration in accounting systems. Each product has its own predefined processing path through the operating environment, which involves a combination of the business components shown here. So for each product, we identify those business components that interact with the product along its end-to-end processing cycle. The result is what we call the product processing profile. A risk mitigation index, or RMI, is calculated for each business component. Because operations managers are concerned with the quality of processes, we also calculate the RMI at the process level relative to all operations business components. Here are examples of 2 best practice scoring templates that provide the primary input for the calculation of the RMI. In this case, they relate to the operations component of processing risk. There are other templates for data management and core applications management as part of processing risk, and also for the other key risk types: credit, market, liquidity, interest rate, and conduct. In order to construct the best practice scoring template shown here, we go to the experts, operations managers and operational risk managers, and ask them what features of operations management do they rely on most to eliminate operational failure. In the case of operations, they gave us these 9 features or best practice categories: control, people, execution, business recovery, risk culture, performance monitoring, legal access management, logical access management, vault management, policies and procedures. We then ask them to weight these 9 categories on a scale of 1 to 10 according to the degree of reliance they place on each one when managing through stress conditions. They gave control, people, and execution a maximum 10 weighting, which means that these categories must be functioning to a very high standard if operational failure in stress conditions is to be avoided. There are 2 types of best practice scoring templates. The one on the left is based on operating benchmarks, and the other on the right on best practice components. For the benchmark templates, we again go to the experts and ask them, what are the subcategories of execution? They named 3 subcategories. 1, the degree of automation, or STP rate, straight through processing. 2, The quality of inputs expressed as the average percent of inputs that is either rejected or repaired prior to processing. And 3, the robustness of the core systems measured by the number of system failures in a year. The benchmarks are then scaled to a range of 1 to 100 according to their relative impact. Process owners in operations then use the best practice scoring template to determine a score for execution relative to their particular process on a scale between 0 and 100. For example, if they reject or repair 5% of the input prior to processing, they score 75 for this subcategory. The actual score that is used for execution will be the lowest score of the 3 subcategories because the negative impact of a low-scoring subcategory negates the positive impact of a high-scoring subcategory. To illustrate this, the operational value added of a 100% straight-through processing process is lost if the system is unstable, that is, it is unavailable more than 12 times in a year. For the best practice scoring template on the right, we again ask the experts, what are the components that comprise a best practice business recovery plan? We then ask the experts to weight each component on a scale of 1 to 100 according to their relative contribution to a best practice business recovery plan. These are the values you see in brackets next to each component. Process owners then score the category relative to their process. They start with a total of 100 and deduct the amount in brackets for each component they do not comply with. We now have all the inputs necessary to calculate the risk mitigation index. Here's the formula. The calculation is performed for each operational process for operations business components and at the component level for all other business components. For each process within an operations business component, we have 9 scores, 1 for each best practice category, that is, control, people, execution, business recovery, etc. So for each process, we multiply the best practice category score by the category weighting and then by the process's inherent risk units. We do this calculation once for each of the 9 best practice categories and then sum these calculations to give us the RMI numerator. We refer to this as the actual score aggregate algorithm. We then repeat the same calculation for the denominator, except we replace all the 9 actual scores with the maximum score of 100, which gives us the maximum score aggregate algorithm. The RMI is then the actual score aggregate algorithm over the maximum score aggregate algorithm, scaled to an index of 0 to 100. As previously mentioned, we have developed a set of best practice scoring templates for each primary risk type. The residual risk in RUs is then calculated by considering the RMI as a percentage and reducing the inherent risk RUs by that percentage. So if the RMI is 85, that means we are effectively mitigating 85% of the inherent risk RUs, leaving 15% of the inherent risk RUs as the residual risk. That is, the amount of inherent risk RUs not covered by effective risk mitigation. The risk accounting software, Advico RAS, performs all these calculations and assigns the resulting values to individual transactions. That means we can now aggregate risk data by the same aggregation paths used for management accounting, business line, cost center, product, customer, geography, as well as by risk type. I'll give you more information on the software in a few minutes. In the next few slides, we'll take a look at some of the reports that are produced by the software. This report summarizes the RMI and RUs by best practice category at the enterprise level. In the 2 shaded columns to the right, we have the aggregated actual and maximum score aggregate algorithms that function as control totals to prove the accuracy of the report. This satisfies a key BCBS 239 accuracy requirement. The totals at the bottom of the report provide the RMI and RUs for the whole enterprise. So this bank has a group RMI of 71.5 and a group residual risk of 4,580 RUs. At the top of the report we have the generic best practice templates, so for example the group people RMI is 72.7. Lower down in the report we have the technical RMIs and RUs for the best practice categories that are specific to a particular risk type. This report provides an excellent framework for the design of balanced scorecards for risk. On this slide, we show some product risk reports. On the left is the All Product Summary Report. The report shows all the business components grouped by risk type, starting at the top with transaction processing risk, and then data quality and core applications that together make up total processing risks. As we go further down the page, we next have the financial risks, market, credit, liquidity, and interest rate, and at the bottom we have conduct risk. As you can see, the totals at the end of the report agree with the best practice report on the previous slide, that is, a group RMI of 71.5 and residual risk of 4,580 RUs. So we have proven the accuracy of the report, which is a BCBS 239 requirement. On the right is a sample product risk report for CDOs that follows the same format. In this case, the RMI is 69.2 and the residual risk is 1,608 RUs. When first applied, the risk measurement system contained in risk accounting will rely on subjective inputs, but these will become progressively more objective and consequently more precise over time. This will be achieved by statistically correlating actual operating losses with associated residual risks in RUs, which will identify refinements that will need to be made to the exposure measurement system in risk accounting. In other words, the outputs of statistical correlation will be used to adjust the tables, templates, and weightings that comprise the risk accounting method and system. The same statistical correlation process will allow us over time to derive a monetary value of an RU, which will enable its further use, for example, to potentially enhance the capital asset pricing model, the CAPM, and risk-adjusted return on capital, RAROC, through the use of explicit measurements of exposure to risk rather than proxies, as well as for internal capital allocations and the determination of minimum regulatory capital requirements. Let's now see how risk accounting can help us achieve compliance with BCBS 239, starting with risk data controls. We can create a framework of risk data controls through a monovalent risk measurement system using a standardized risk metric, the RU, and permanently tagging transactions with RUs, which enables effective and controlled risk data aggregation. Reconciling risk data to accounting data. The source of data for risk accounting is the general ledger, and it runs in parallel with management accounting, so risk data is directly tied to an already proven and trusted source of accounting data. Build to a single authoritative source for risk data. Our proposition is that the risk accounting system, as an extension of the general ledger and management accounting, will become the single authoritative source of risk data. All risk reports will be reconcilable to that source. This also provides a solution for Principle 6 of BCBS 239, adaptability, as on-demand ad hoc risk reports can be generated from that single source. Moving on to risk reporting, capital adequacy, we believe it will be possible to use the risk accounting method to restate a firm's balance sheet in RUs to produce a risk balance sheet. As we discussed in an earlier slide, it should be possible over time to derive the monetary value of an RU. That being the case, the opportunity exists to use risk balance sheets in RUs as a basis for determining capital adequacy. Regulatory capital. Using the same thinking we use for capital adequacy, risk accounting also creates the potential for regulators to use RUs in the determination of regulatory capital requirements. Capital ratios. Risk accounting enables the explicit and dynamic calculation of exposure to risk using a standardized risk metric, the RU, that can be used to provide more relevant, risk-based calculations of capital ratios. Processing, credit, market, liquidity, interest rate, and conduct risk. The explicit and dynamic calculation of exposures to these risks is a natural output of the risk accounting method by design. Stress testing. If we approach stress testing with the additional and more comprehensive and representative risk information provided by risk accounting, which is directly comparable within and between financial firms, this should lead to less reliance being placed on stress testing to determine the exposure to risk of whole enterprises. Particularly significant here is the fact that through risk accounting, we can start with an understanding of an enterprise's inherent risk, that is, its maximum potential for loss. Risk appetite setting and monitoring. And one last but very important point is that a firm's risk appetite can be more meaningfully determined using RUs. Given that the general ledger, management accounting, and risk accounting are all tied together and are drawn from a common source of data, a firm's risk plan in RUs can be produced in exactly the same format as its financial plan, and together they comprise the firm's business plan. It also means that if a firm's risk appetite is set in RUs, and reporting is also in RUs, the potential is created for the real-time reporting of excesses over approved risk appetite limits. To summarize, the key features of risk accounting are that it is simple. There is no reliance on complex quantitative modeling techniques. The tables and templates are the product of expert input and validation, which means the knowledge and intellect of management and supervisors become embedded in the actual fabric of the risk measurement system. Report production is timely, as calculations of exposure to risk in RUs are performed upon transaction capture in the general ledger and consequently can be reported in real time. Calculations of exposure to risk are representative of the risks actually accepted. And perhaps most importantly, the outputs in RUs and the RMIs are aggregatable. They can be validly aggregated by various categories such as organization, risk type, location, customer, product, etc. The outputs are directly comparable within and between financial firms, provided standardized tables and templates are applied. The outputs are also auditable. The method uses a standardized measurement-based metric, so its outputs are fully auditable. And finally, the Group Risk Mitigation Index, or RMI, is the de facto measure of an enterprise's risk culture, as it blends all of the risk attributes across the whole enterprise in a single metric. As previously mentioned, the risk accounting method is contained in software Advico RAS, developed by our technology partner, Advico, using SAP technology and business objects for visualizations, mobile apps, and report production. It is designed to run on SAP Bank Analyzer and SAP HANA, but there is also an open source version for non-SAP users. Advico RAS is the product of many years of research led by Financial Intergroup, working with the Durham and Leeds business schools. These activities are ongoing as we constantly refine the method and system and prove its value. Advico RAS is designed to allow users to tailor their own tables and templates and associated weightings to their particular requirements. It supports two versions of the tables and templates, one for internal application and the other for external application. The external version could be used, for example, by regulators to ensure consistent application of the method from bank to bank. A global financial institution consortium is also being formed to oversee the development and dissemination of risk accounting standards. Thank you for taking the time to take this tutorial. We hope it has been valuable. For more details about the Advico RAS software, you can follow this link, www.advico.com/en/ras.html. We also offer accounting training courses. For details of these and information generally on risk accounting, you can contact me, Peter Hughes. My contact details are on this slide, or by visiting our website www.financialintergroup.com.